Hello guys, welcome to this YouTube channel. We're going to be looking at how to identify ideal order blocks and how order blocks are traded within order flow. In case you do not understand how to identify ideal institutional order flow, there is a video in the YouTube channel that you can go search and watch for you to actually understand how to identify and mark out ideal institutional order flow. What is an order block? An order block is actually a set of orders to buy or sell. In simple terms, order block is a demand or a supply candle. It provides us with the information of where there is a high probability of reversal and causes the price to drive impulsively in a trendward direction. In another simple term, we'll just say that order block is basically the last price zone where the institutions have placed their orders before the main market move happens, or before an ideal impulsive move happens leading to a change in market character or a break in market structure. So the institutions actually trade using order blocks. Order block is similar to the order flow and have the same function, but the only difference is that order block is created from a single candle. And then one of the mistakes traders actually make is when they only wait for the mitigation of the order block without actually considering that price can mitigate just the order flow and continue in its trend. So let's head to the chart for you guys to actually understand how to spot out an order block. So you can see here we have our bullish order block. So we have the bullish order block and then we have the bearish order block. So you can see here we have the bullish order block. The last selling candle before the bullish move to the upside. So this is our bullish order block. And the bullish order block, when you're looking at it from a price action perspective, is found within our zone of support. So we have also the bearish order block. The bearish order block is the last buying candle before the sell move to the downside. And basically, when you're looking at it from the perspective of the price action trading methodology, we find our bearish order block within our zone of resistance, or around our zone of resistance. So this is our bullish order block, the last selling candle before the buying move to the upside. And then this is our bearish order block, the last bullish candle before the sell to the downside. What are the characteristics of a tradable order block? So for us to actually mark out ideal institutional order block, we must understand and know the characteristics of an ideal institutional order block or a tradable order block. And one of the characteristics of a tradable order block is that it takes out liquidity of the previous candle high or low. Depending on the market condition, it creates an impulsive move that leads to a break in market structure. A tradable order block should be unmitigated order block that haven't yet been retested. A tradable order block should have imbalance. So these are the characteristics you must look out for when marking out your order block. For it to be an ideal institutional order block or invalid order block. So let's look at this example here. So we said that our bullish order block is actually the last selling candle before the buying move to the upside. So we would see from this chart example here that we have this as our valid order block. Why is this our valid order block? Because you can see this fulfill the characteristics of a tradable order block. You can see this candle weak low grabbed the liquidity of this candle's weak low. Though we can see that this is a bullish colored candle, but it is the last selling candle before the buy move, because you can see the weak low is lower than this other previous candle's weak low. And then it swept the low of this previous candle's weak low. And then you see we have the push to the upside. So you see we have the grab of liquidity and then we have imbalance created here. And then you can also see this sponsored the move to the upside that broke structure here. So this is a valid order block because we have the grab of liquidity and then we have the imbalance. And you can also see another criteria that it broke the market structure. So you can also see price went to the upside here. We have this candle move to the downside, raided the low of this candle, grabbed liquidity here, and then you see the push to the upside. This becomes our order block. Why not this bullish candle here? You would see that this bullish candle is just an inside bar within this candle, because you can see the low is protected, the high is protected. This candle raided the low of this bullish candle. So this is our ideal candle to mark out. So we have the fair value gap here, which is the imbalance from the high of the first candle and then the low of the third candle. This is not our first candle. This is inside within this candle. So this is invalid order block. So you can see now from this other example here, we have the rate of liquidity here. This is a bearish candle, but this is the last bearish move before the impulsive move, because you can see this week low is lower than this. So price grabbed the liquidity of this previous bearish candle. You can see here, we do not have inefficiency here. Even though we have the graph of liquidity, there is no form of imbalance here, because this candle mitigated any form of imbalance within this order block. So we see that this order block moves from this candle to this particular candle, because you can see when price made a move to the upside, this mitigated any form of inefficiency here. But then you have price imbalance here. So the order block shifts from this candle towards this candle in reference to this imbalance here, because this is actually an ideal order block because it actually grabbed this liquidity. But then we have this as the imbalance resting here due to this candle mitigating any form of imbalance within this candle. So the order block shifts towards this other candle here due to the imbalance resting here. But you can see in this other candle here, this is not really a valid order block, because you can see price move to the upside. But then this return did not raid the low of this candle. We do not have any form of liquidity sweep here. Though we have imbalance, we have one of the requirements here. We need at least two of the requirements for it to be regarded as a valid order block. So you see, we do not have a rate of liquidity here, though we have imbalance resting here. So this is not a valid order block. So let's also check another example regarding how to mark out a valid order block. You can see from this example here, we have this candle raided this week low. Now price pushed to the upside, but we do not have any form of inefficiency resting here. This candle did not push price to the downside to raid this candle's low, and then we do not have any form of inefficiency resting here. So this is not a valid order block. We do not have rate of liquidity. We do not have inefficiency. We have rate of liquidity, but we do not have inefficiency resting here. Now you can see this other candle price came, raided this candle's low, have the rate of liquidity here, but we do not have imbalance resting here. So this is not a valid order block. So the order block shifts from this candle to this other candle resting here, because we have imbalance resting here if we have another created candle here. So this is just an example I'm actually showing you guys on how to mark out an ideal order block. You can see in this other example here, we have our valid order block resting here. This is the last buying candle before the sell move, because you would see this week high is higher than this previous candle's week high. So it raided the liquidity here, and then we have the push to the downside. Now you see price push to the downside, left imbalance here. So you see rate of liquidity, and then we have imbalance here. So price push further to the downside. We have price return, price raided this week high. This is our order block. Now you would see price raided this liquidity and then sponsored the move to the downside. We won't really mark out this bearish candle as the order block, because this candle did not raid the high of this candle. So this is our order block. And then you see the imbalance from the week low to this third candle week high. This is just an inside candle within this candle move, because this candle did not move sufficiently to the downside to raid the low or move to raid the high points. So you will see that now this is our order block, and then we have our price imbalance resting here. So there is also a way you can also mark out order block in reference to the week. When the week of the candle is more than 50% of the candle body, then you can make reference to the week as your order block zone. we would see that in the charts, how to actually mark out the week as an order block zone. Then you also have the other example where the candles week engulf the other previous candles week also, and also grabs the liquidity of that candle week. And also the candle week is a bit more or relatively equal to the candle body. We would see all of this in the charts. So before we head to the chart, I would also want to show you guys how to really identify these structure points where you mark out your order blocks theoretically, so that you would understand when we head to the chart how we actually spot out these things. So before we head to the chart, I would like to theoretically show you guys how we really want to be marking out these order blocks as also POI zones, our point of interest. So I won't really explain more on market structure in this video. There's a video already in the YouTube channel that actually explains how to identify ideal institutional market structure. So in case you do not know how to do that, you can actually check that video and watch that video. And please guys, if you're actually gaining value from this video, please guys, kindly subscribe to this YouTube channel, like and share this video. You can also post your comments in the comment section if you have any questions that you need me to really address. So let's head to the charts. So you can see here we have price movements to the upside here. We have price created our inducements, price return, rated our inducement. So we have this as our valid high. So now you can see that price went to the upside, came here. So we see that price grabbed the liquidity resting here. So you would see that this movement came to the downside and then grabbed this liquidity. We have pushed to the upside, price created an inducement before the break of structure. A lot of people would actually mark this as their point of interest. No, price have not yet rated the inducements. In the video where I explained how to mark out market structure, I said the market would move to grab external liquidity, internal liquidity, and then feel inefficiency. So inducement is also a form of liquidity. You will see that price will return to read the inducements. So you would see some traders will mark out the inducement zone as their POI zone. No, this is not an ideal zone to mark out because price would come, possibly give you a little reaction, but this is the ideal POI zone to mark out because you would see that price rated the liquidity resting here. So this is the POI zone to mark out in reference to the order block. So also you can see from this other example here, price created the inducements. This high did not return to rate the inducement, so this is not a valid high. Price created this low, went to the upside, broke this structural point. Price now came to the downside, rated this low, swept the liquidity. Our inducement shifts from this low to this particular low. Now you can see the sweep of that low. This is a valid high point because this high point sponsored the move to the downside that swept this low. So you would see now price went further to the upside, return. This is an inducement and then push further. So what we're expecting is to see price rate this inducement. So where is the POI zone for you to really want to mark out? This is where you should mark out as your POI zone. The order block resting around this zone should be what you should pay attention to because you can see the graph of liquidity here. So price may come to the inducement zone, react a little, but will fall down to this zone because you already have the graph of liquidity, and then price will push further to the upside. I'm just showing you guys more theoretical examples so that you would really understand this. You can also see this here. We do not have this price movement to the downside to rate this low. Price went to the upside. Other traders will mark this as a zone also to pay attention to, expecting price to return possibly to this zone to react. But actually the ideal zone to look out for is this particular zone because you already have the graph of liquidity here already. Price grabbed the liquidity here. So you would see that price will return to that zone and then push forwardwards to the upside. So let's look at the last theoretical example before we head to the charts. In this example here, you would see that this also did not rate this low points here. This is not an ideal point of interest. So you see price again push further. We have a retracement. This is an inducement. The inducement shifted to this particular swing low because inducement is created before a break of structure or it can also be after the break of structure. I won't really stress that. There is already a video on how to really mark out what's ideal institutional market structure. You can do well to check the channel and watch that video. So we see we have the break of structure here. Price have not yet raided any inducement. This is the inducement. So you would see that price can just return, just rate the inducement and then push further to the upside. Because this is not really a valid POI because there is no graph of what? Liquidity. So price will just return to a possible inefficiency resting below the inducement zone. Then price will tap into the inefficiency and then push furtherwards to the upside. So we'll check the charts, how to mark out these things, how to spot out your ideal institutional order block. And then also we'll see how price mitigates order flow without really returning to the words order blocks. So let's look at this real-time chart example on how to identify your ideal words, institutional words, order blocks. So you can see here we have price movements to the downside, meaning our order flow here is what? Bearish, because you can see price moving what? To the downside. How do you mark out the order flow? The buy move before what? The sell move that what? Grab the sell side what? Liquidity. So this is what? The first order flow. The buy move, that's also the sell move that grabs liquidity and breaks structure. So you can see this is now the order flow what? Zone here. So you can see here price would grab the liquidity resting here. That is the sell side liquidity resting here. So price grabbed that liquidity with this candle move, took out this candle low, the sell side liquidity. Now you can see then we have this return into the order flow after the grab of the what? Sell side liquidity. But this is the move that validates the break of the structure because this is the candle that closed below this recent candle low and then below the what? Swing low. So this is the move that validates the break of this what? Structure point here. So you see we have now price came after the grab of the sell side liquidity, mitigated the what? Institutional what? Order flow here. So we have this as the last buying move before the sell move that actually gave us a valid break of what? Structure. So we have this order block resting here within the IOF zone. Price didn't really return into to mitigate the order what? Block. You can see price just mitigated what? The IOF. Now this is an ideal order block because you can see price grabbed this liquidity resting here and then we have what? Inefficiency resting here. Also you can mark out the what? Wick because you can see the wick is more than 50% of the candle body. That is why you see I marked out what's the wick. But you would see that price did not return really into the what? Order block to mitigate it, but price returned into the order flow. So you must be looking at what? Price from also the order flow perspective and also what? The order blocks perspective, also what? The imbalances. So I now told you guys also in the other video regarding price imbalance that you also mark out the inefficiency within the zone of the what? Broken structure. So you can see this is what? The inefficiency there. So this is the move that actually validated the break of the structure and took out this what? Candles low. So you can see we have what? Inefficiency resting here. So you see price came into that inefficiency, filled it up, and then you see drop to the downside. So you can see that what? This is a valid order block too, because you can see this sponsor they moved to the upside, raided these words, needed this liquidity resting here. This is the valid order block because we have the raid of liquidity and then we have what? The imbalance here. So you can see price return mitigated what? The order block before we have what? Price push what? To the downside. So you would see that this is our order flow from the low to the high here. So you see within the order flow, we have the order block here that have not yet been mitigated. We have unmitigated order block here. So you would see this is an ideal order block. Why? Because it grabbed liquidity and what? Left imbalance. So it is a valid order block. But you would see that what? Price just returned to what? Mitigates the order flow. So price just returned to mitigate the order flow. So I said something that worked. We also mark out the inefficiency within the zone of the broken structure. You can see this is the inefficiency resting here. And then you can see what price did was to mitigate the inefficiency, tapped into the order flow without really returning into the order block. So we must be looking at trading from that perspective. We must be looking at trading from the order flow perspective and also the order block perspective. So you would see that now, in this case or in this particular scenario, within the order flow zone, you see that this movement already mitigated this order block and we have a newly created order block. You would see that in the future, price would actually react to all these unmitigated order blocks within the order flow zone. In this case, price have just been mitigating the order flow and not really the order blocks. You would see in this particular price move here, now price mitigated the order flow here, and then you see price drop to the downside. Now you would see we have an ideal order block here when price returned to mitigate the order flow, because this is our inducement. Price already took out the inducement. And then you see that this candle took out this liquidity resting here. So this is our order block. And then it left inefficiency here from the candle low to this candle's high here. So price came to the downside, return, mitigated the order block. This is not your order block. Neither is this your order block. This is the ideal order block because this candle took out this liquidity, and also you also have the imbalance. So you see price return into it, mitigated it. This becomes also the next order block. After the mitigation of this order block, price created a new order block because you would see that this candle here took out the high of this candle. This is the lowest candle. Price return took out the high of the candle, and then we have price imbalance here. After the break of structure, you see we have this return and then price push. This is our inducement. Yeah. So this is our inducement. So price came, took out the inducement, mitigated this order block because this is a valid order block. It took out liquidity, left inefficiency. Price tapped into the order block. So you see we now have the next order flow here. We now have the next institutional order flow here. Now you would see within the order flow, this all happened within the order flow. So price came, mitigated this order block, fell to the downside and broke structure here. Now you would see that price gave us another order block here because this candle raided the high of this candle. It is the lowest candle. You can see the wick is the lowest candle resting here before the push to the upside. Price pushed to the upside, raided it, and then we have a fall. So this is our valid order block within the order flow zone. So you can see we have this valid order block within the order flow zone. Now you see price return tapped into the order block and the order flow, and then we have this price reaction to the downside. So in this particular case here, you would see that price was not really returning into the order blocks, but the order flow. So when you're trading, you must also understand that price can mitigate the order flow without returning to mitigate the order block within the order flow zones. So what do you look out for in an order flow zones? You look out for the order blocks and then the inefficiency within the order flow zones. So this is what you would look out for. But in the future, you would see that price all return to mitigate all these order blocks because they are ideal order blocks. So let's project this to the future. You see that price came, reacted to it, and then fell to the downside. Let's look at this other one here. You can see that price came, reacted to it, and dropped, but then price raided it to the upside because you already know that the market character has already changed because you already have the break of this high points here. So we have the change of character here. So let's also project this other one. Price mitigated this, but you can also see that this wick of this other candle engulfed this other wick. So price still returned to the wick zone of this candle. Let me project it out for you to see just the wick because the wick engulfed the other candle. So you would see price return to mitigate the wick. I'll teach you guys about wick mitigation, but for now, let's just look at just the blocks. So you would see that price came, mitigated the wick here, and then dropped to the downside. So you would see also price return to this other block that haven't yet been mitigated. Let's project it to the future. You would see it here. Price came, tapped into it, and then we have a little reaction to the downside. Now you see price already mitigated this order block. So you do not really have a reaction around this order block. This is the order block here. And the wick of the order block has already been mitigated. This movement to the upside is already within this wick already. So you would see price rated it without really respecting it. This order block too has already been mitigated. That is why you would see price just ran through it here. So you see price just ran through it because the order block has been mitigated by this movement. So when doing your analysis, you must also pay attention to the order flow zones. You can see price mitigating order flow zones without really mitigating the order blocks within the order flow zones. So that is what you should also put into perspective. So I would also show you guys another chart example. Let's look at this chart example. So you can see here we have price movement to the upside. We have change in market character because the market actually has been bearish, and then we have the market turning bullish here. So you can see we have this as the order block. You can see this rated this low, took out liquidity, and you can see the wick is more than the candle body. So I marked out the wick. So you would see that now price push further to the upside. We have change in market character. We have ideal order blocks being formed within this leg move. So let me treat actually those ideal order blocks. You can see this order block came, grabbed this liquidity, push price to the upside, left inefficiency here. You'd see price return into the order block, and then we see price push to the upside. This return created an order block, but I won't really regard this order block because this movement is not a valid pullback. It is within this bullish candle because you can see the high is protected, the low is protected. This is not a valid pullback. So you would see that now price pushed to the upside, created an order block here because you can see this swept to the low of this candle, where you can see price mitigated it, pushed further to the upside. So we'll have our leg move from here. Price return created this inducement. Inducement was not rated. Price pushed further, came to the downside, and then pushed to the upside, created this inducement, tapped into this inefficiency here. So you can see price push further, then return and rated the inducement resting here. So we now have price movement to the upside. This is our valid high points because this dropped to the downside and rated the inducement resting here. And then you see price move further to the upside. Now this return is not really a pullback because you have the high protected and then the low protected. Then you have a push to the upside. Price broke structure here. Order block is here because you can see price took out this low, which is also an inducement. So you would not regard taking trade from here because it is an inducement because the inducement was formed and then the break of the structure. So now you see, what do we have? We have our equal lows resting here. So you would see that the only order block left unmitigated after the break of structure is the one resting here. So you see price return, tapped into it, and then we have the push to the upside. It is a valid order block because you can see price rated this inducement here. And then you can also see the wick itself is more than the candle body. You also have the imbalance resting here. So price return into the order block here, tapped into the wick, and then you see pushed to the upside. You can also see this is a valid order block because you can see dropped liquidity after tapping into the zone. I will teach entry models in this video. I'm going to gradually take this journey and then we'll come into entry models. So price rated this low here, and then you see price push to the upside, creating the imbalance from the high to the low of this candle. So you can see price return, tapped into it, and then we have push to the upside. And one thing I want you to take note of, you don't trade in the order block straight away. You wait for price to return into the order block, then you take your entry. So you see price return into the order block, and then we have push to the upside. This is also an ideal order block because it rated this low, sponsored the move to the upside. This is our order block, this candle, the doji candle we are seeing here, because it took out the low. So meaning it formed the inefficiency from the high to the low of this candle. price return, tapped into it and push further. So this is the order block here has already been mitigated, but you can see that what price anyway return, created this inducement, rated inducement, returned into the inefficiency. There is no any valid order block here. We don't have any valid order block here, but anyway, price return, retested it due to the inefficiency and then push what's to the upside. This is where we have the order block, but we already have the mitigation of the order block. So price push to the upside. So you can see we have a break of structure here. We have a valid order block here because this order block took out liquidity, but you see price already mitigated the order block here, pushed to the upside. So this is how you look out for what order blocks. You see price return, you already have what an ideal order block again here because it rated this low, and then you see price push to the upside, returned into it, and then you see price push what further what to the upside. So this is how you look out for what's your what order blocks. So let's look at this as another example. You can see here that what we have an ideal order block because you can see a graph of this liquidity. This candle swept the high of this candle, left inefficiency. So you can see price drop to the downside, broke structure, and then you can see the return into the order block here. Price mitigated the order block, and then you can see we have this fall off here. Before price came and took out the sell side liquidity, we have this order block resting here, grabbed the liquidity of this candle's high, left inefficiency, price return, didn't fill up the inefficiency enough. So after the grab of the external liquidity, you can see price return to fill up the inefficiency, and then it tapped into the words order block itself, and then price fell to the downside. So there are in lots of examples you can check on the chart. So you do well to just backtest and backtest your charts. You can also see here, we have this order block here. Price rated the low of this candle here, left inefficiency here. You can see price push to the upside, price return, fill up the inefficiency, tapped into what the order block, and you can see a push what's to the upside. You can also see here that what price here took out this liquidity here, and then you can see that now what we have the fair value gap here, the imbalance from the high here to the low here. You can see price push to the upside, return, tapped into the order block, and you can see what price will push to the upside. So this is how you look at for what order blocks. So I believe this video has helped you, is resourceful. The best thing you can do actually is to backtest the chart, This is how you get to understand these things. Next time we'll be having chart replays for you to be seeing all of these things playing out. But for now, I'm teaching you from a backtesting perspective for you to actually understand these things and how they actually work. Cheers and God bless.